Oil prices jumped yesterday, yet overall the sideways motion seems to be maintained. Today we are going to have a look at the US oil market, continue to discuss the possibility of OPEC delaying hiking its oil production levels, discuss the possibility of increased oil demand, and have another look at the troubled Middle East. We are going to conclude the report with a technical analysis of WTI's daily chart. We examine the data on the ground of the US oil market, try to interpret their meaning and make a start with the release of the Baker Hughes active oil rig count last Friday. The release showed that the number of active oil rigs in the US decreased by reaching 480. The decrease tends to imply that oil demand in the US oil market eased, forcing oil producers to shut down oil rigs. Yet the release was overturned on Tuesday as the American Petroleum Institute reported a decrease of US oil inventories by 573,000 barrels, taking the markets by surprise. API's drawdown was reaffirmed next day as the Energy Information Administration also reported a drawdown in US oil inventories of similar size at minus 517,000 barrels. The decrease of US oil inventories tends to imply that the US oil market is tightening as oil demand levels tend to exceed aggregated supply of oil in the US. Should we see further signs of a tightening US oil market in the coming week, we may see oil prices getting some support. Yet despite news hitting the market last week that Saudi Arabia is preparing to raise oil output levels, Reuters reported that OPEC Plus could delay hiking the oil production levels of member states beyond December. OPEC Plus is expected to increase its oil production by 180,000 barrels per day, and please note that initially that increase of oil production levels was already expected in October, yet was delayed as oil prices were falling and a possible increase of oil production could weigh on oil prices even further. Should the oil-producing cartel actually decide to delay the oil production hike, it would practically expand the strain on the supply side of the international oil market, which in turn may also have a bullish effect on oil prices. Furthermore, we would note that increased economic activity in the manufacturing sector of China, as implied by the release of October's NBS PMI figure in today's Asian session. The increase tends to imply that the measures taken by the Chinese government to boost economic activity are actually working, yet we tend to maintain our doubts and we would require further evidence to that end. Yet should the release be also accompanied by a similar reading of the Caixin manufacturing PMI figure for the same month, and from the US an improvement of the ISM manufacturing PMI also for October, could allow speculation for an improved oil demand outlook in the pre-mentioned countries, which are huge consumers of oil. Thus, further signs of increased economic activity in the manufacturing sector could provide some support for oil prices, yet that remains to be seen. WTI's price action edged higher after bouncing on the 66.80 support line, yet the commodities price action tended to act as confirmative of its sideways direction between the S1 and the 72.20 resistance line. Yesterday's upwards movement was somewhat expected, given that the price hit on the lower Bollinger Band before correcting higher. We tend to maintain a bias for the sideways motion to be maintained as long as the WTI's price action remain between the R1 and the S1, yet also note that the RSI indicator remains below the reading of 50, implying a residue of bearish predisposition on behalf of market participants, yet not direction defining for the time being. There may be an extension of the buying interest, yet for a bullish outlook, we would require WTI's price action to break the 72.20 resistance line, opening the gates for the 77.80 resistance level, which successfully reversed the commodities price upwards movement on the 8th of October. Yet one could argue that the commodities price action is forming series of consecutively lower peaks and lows since the 8th of October, and the downwards motion limitation are highlighted by the downwards trend line incepted since that date. For a bearish outlook, we would require WTI's price action to break the 66.80 support line clearly, thus paving the way for the 61.65 support barrier, a level that has not seen any price action since the 20th of August 2021. Thank you for tuning in to our financial news. From all of us here at IronFX,